Welcome to this book summary of The Intelligent Investor, the timeless investing classic by Benjamin Graham. This book lays the foundation for value investing and has influenced legends like Warren Buffett. Let's break it down chapter by chapter and extract the most valuable insights. Chapter 1: Investment versus Speculation. Investment is a disciplined approach where an investor conducts thorough analysis, ensures safety of principal, and expects a reasonable return. Speculation is akin to gambling, where individuals buy assets based on market trends, news, or price movements without proper research. Graham stresses that true investors focus on fundamental analysis rather than price speculation. Key lesson: investors must adopt a rational mindset and differentiate investment from speculation to protect their wealth. Example of investment versus speculation. In the 1990s, many investors speculated in the dot-com bubble, buying tech stocks based purely on hype without understanding the company's fundamentals. Conversely, Warren Buffett famously avoided such speculative stocks and focused on investing in companies with strong fundamentals, like Coca-Cola. Chapter 2: The Investor and Inflation. Inflation erodes purchasing power over time, reducing the value of money. Fixed income investments like bonds are highly susceptible to inflation risk. Stocks, particularly those of companies with pricing power, offer better long-term protection. To safeguard wealth, investors should diversify their portfolio and include inflation-resistant assets such as equities, real estate, and inflation-protected securities. Graham warns against holding excessive cash, as inflation diminishes its value over time. Example of the investor and inflation. During the 1970s, inflation in the United States soared, eroding the purchasing power of money. Investors who were heavily invested in bonds saw their returns diminished. On the other hand, investors in companies like ExxonMobil, which had the ability to increase prices with inflation, were better protected. Chapter 3: A Century of Stock Market History. Markets move in cycles, with periods of strong growth followed by downturns. Studying past market trends helps investors understand the impact of economic events on stock prices. The Great Depression, post-war booms, and economic recessions provide lessons on market behavior. The key takeaway is that no single period of market boom or bust lasts forever, reinforcing the need for patience and long-term thinking. Example of a century of stock market history. The Great Depression of 1929 saw the stock market crash, wiping out much of the wealth of the time. However, investors who remained patient and stayed invested in the market, like those in the post-World War II era, eventually saw their investments recover and thrive, proving that market cycles offer opportunities for long-term investors. Chapter 4: General Portfolio Policy. Investors must choose between two approaches: the defensive investor, who prefers passive, safe investments, and the enterprising investor, who opts for active, research-driven investments. Asset allocation should balance between stocks and bonds, typically in a 50-50 ratio, adjusting based on risk tolerance and market conditions. Graham suggests never having less than 25% or more than 75% in either stocks or bonds. Strategy. A disciplined, well-thought-out strategy is crucial to long-term success, and investors should rebalance portfolios periodically. Example of general portfolio policy. An investor following the 50-50 asset allocation approach would have split their investments between bonds and stocks. For example, during the 2008 financial crisis, while stock prices fell sharply. Chapter 5: The Defensive Investor and Stock Selection. The defensive investor should focus on high-quality, well-established companies with a strong history of stable earnings and consistent dividends. Key criteria for selection include large, financially sound companies, a history of at least 10 years of consistent dividends, a conservative price-to-earnings ratio, and low debt levels. Avoid speculative and high-volatility stocks that pose unnecessary risks. Dollar-cost averaging is a recommended strategy for long-term investing. Example of the defensive investor and stock selection. A defensive investor might choose to invest in companies like Procter & Gamble or Johnson & Johnson, which have a long history of stable earnings, consistent dividends, and low debt. These companies offer safety and reliability, even during economic downturns. Chapter 6: Portfolio Policy for the Enterprising Investor. The enterprising investor is willing to conduct in-depth research to identify undervalued stocks. Strategies include investing in neglected or unpopular stocks that have solid fundamentals, taking advantage of market mispricing and temporary setbacks, and looking for bargains through financial statement analysis. This approach requires patience, discipline, and emotional control to avoid speculative temptations. Example of portfolio policy for the enterprising investor. An enterprising investor might buy undervalued stocks like Apple in the early 2000s, when it was trading for relatively low prices despite having solid fundamentals. Through careful research, this investor would have identified Apple as an undervalued company and benefited from its later success. Chapter 7: Value Investing Principles. Core principle: buy stocks below their intrinsic value. Investors must analyze financial health, earnings stability, and industry position. Graham's formula emphasizes buying with a margin of safety to reduce risk. Price is what you pay, value is what you get. Look beyond price movements to assess true business value. Value investing focuses on fundamentals rather than market sentiment. Example: in the early 1990s, Warren Buffett invested in Geico, a company trading below its intrinsic value, because he believed the company had a solid business model and long-term potential. He bought it at a price much lower than its true value, which allowed him to earn a significant return as the stock price eventually rose. Chapter 8: The Investor and Market Fluctuations. The stock market is highly unpredictable, often driven by emotions rather than fundamentals. Market fluctuations create buying opportunities for disciplined investors. Graham introduces the concept of Mr. Market, a metaphor for the stock market's irrational behavior. Successful investors take advantage of fear-driven sell-offs rather than reacting emotionally. Avoid panic selling during market downturns and recognize volatility as an opportunity. Example: during the 2008 financial crisis, many investors panicked and sold their stocks, but those who remained calm, like Warren Buffett, saw it as an opportunity to buy undervalued stocks. Buffett famously invested in companies like Goldman Sachs during the crisis when others were fearful. Chapter 9: Investing in Mutual Funds. Studies show that most mutual funds underperform the market due to high fees and poor stock selection. Index funds, which track the overall market, provide a low-cost, superior alternative. Investors should be cautious about mutual fund marketing and always check long-term performance before investing. Active fund managers rarely outperform the market consistently over time. Example: an investor might choose an index fund like the Vanguard 500, which tracks the performance of the S&P 500. Over time, this passive investment typically outperforms actively managed mutual funds due to lower fees and the difficulty of consistently beating the market. Chapter 10: The Investor and Investment Advisors. Many financial advisors have conflicts of interest, often recommending investments that benefit them more than the client. Seek fee-only advisors who prioritize unbiased advice. Educating oneself about investment principles reduces dependence on advisors. A knowledgeable investor can avoid excessive fees and poor investment choices. Example: an investor working with a fee-only advisor might avoid conflicts of interest and receive unbiased recommendations. For example, they might receive advice to invest in low-cost index funds rather than a commission-driven advisor who might push higher fee products. Chapter 11: Security Analysis for the Lay Investor. Investors should analyze company fundamentals before investing. Important factors include earnings consistency, revenue growth, debt-to-equity ratio, and profit margins. Avoid companies with unstable earnings and excessive debt. Read financial statements to understand a company's financial health. Example: before investing in a company like Walmart, a lay investor might review its earnings consistency, revenue growth, and debt levels. By comparing Walmart's fundamentals to those of other companies, the investor can make a more informed decision about its potential as a long-term investment. Chapter 12: Things to consider about per-share earnings. Earnings per share, or EPS, can be misleading due to accounting adjustments. Look beyond EPS to assess a company's true earning potential. Focus on long-term earnings stability rather than short-term fluctuations. Compare earnings with actual cash flow and balance sheet strength. Example: In the late 1990s, many technology companies manipulated their earnings reports to show high earnings per share, EPS. A company like Lucent Technologies, which reported high EPS growth, was not necessarily a good investment, as its underlying business fundamentals were not strong. Chapter 13. A comparison of 4 listed companies. Graham compares companies with different financial health and market conditions. Lessons from real-life case studies highlight the importance of evaluating financial statements before investing. Financial strength, management quality, and valuation determine investment attractiveness. Example: when comparing companies like Ford and General Motors in the early 2000s, an investor might have chosen Ford due to its stronger financial health, better management, and lower debt. This comparison highlights the importance of analyzing financials before making an investment decision. Chapter 14. Stock selection for the defensive investor. Defensive investors should focus on large, stable companies with long operating histories, companies with a low price-to-earnings ratio relative to industry averages, stocks with a strong track record of dividend payments. Avoid high-risk speculative stocks that lack earnings stability. Example: a defensive investor might choose a company like Coca-Cola, which has a strong brand, consistent earnings, and a long history of paying dividends. Coca-Cola's stable nature makes it a good fit for conservative investors who prioritize safety over high returns. Chapter 15. Enterprising investor stock selection. Enterprising investors must look for undervalued stocks with strong fundamentals. They need to conduct deep research into company financials, avoid stocks with unsustainable growth expectations, and monitor insider buying and selling trends for additional insights. Example: an enterprising investor might identify undervalued stocks like Amazon in the early 2000s. At the time, many viewed Amazon as an overvalued, speculative tech company, but an enterprising investor who conducted thorough research would have seen Amazon's growth potential and invested early. Chapter 16. Convertible issues and warrants. Convertible bonds and warrants offer hybrid investment opportunities, but, they carry risks. Most investors are better off avoiding complex financial instruments unless they fully understand them. These instruments often dilute shareholder value over time. Example: an investor might look at a convertible bond from a company like Tesla, which allows them to convert the bond into shares of stock at a later date. While this offers potential upside, it can also dilute the value of existing shares, so investors should be cautious about such instruments. Chapter 17. Comparing 4 listed companies. Further analysis of companies shows that financial discipline is crucial. Understanding intrinsic value is the key to making informed investment decisions. Investors must verify financial health before making investment decisions. Example: when comparing 4 companies like McDonald's, PepsiCo, Coca-Cola, and Wendy's, an investor might choose McDonald's for its stronger financials, better return on equity, and consistent performance over time. This comparison emphasizes the importance of assessing the long-term viability of a company before investing. Chapter 18. The defensive investor's dividend policy. Dividend-paying stocks provide stable income and reduce investment risk. Reinvesting dividends allows for compound growth over time. A strong dividend history often signals financial strength and management reliability. Look for companies that grow dividends consistently over time. Example: an investor might focus on dividend-paying stocks like AT&T, which has a long history of providing reliable dividends to shareholders. By reinvesting dividends, the investor can take advantage of compounding growth over time. Chapter 19. Margin of safety, the core of value investing. The margin of safety is the principle of buying investments at a price lower than their intrinsic value. This approach minimizes downside risk and ensures long-term gains. Warren Buffett considers this principle the foundation of successful investing. Example: Warren Buffett applied the margin of safety principle when he purchased shares of American Express during the 1960s. Despite a temporary decline in its stock price, Buffett saw that American Express was a fundamentally sound company with long-term potential, which allowed him to invest with a margin of safety. Conclusion: timeless investing wisdom. Example: the principles in The Intelligent Investor have stood the test of time, influencing investors like Warren Buffett and Charlie Munger. Their long-term approach to investing, Focusing on value, margin of safety, and patience has led to tremendous wealth creation over decades. Thank you for watching my channel. If you like the content, please like and subscribe my channel. Share this with your friends. This will encourage to bring more topics like this again. See you in my next video.